makers and market movers. This is The Pulse with Francine Lacqua.
Welcome to a special edition of The Pulse, live from the Berlin Global Dialogue, uniting leaders from business, politics, and academia on the biggest issues facing the global economy. But first, here are the top stories making the headlines this morning. Tech shares leading global stocks higher as investors wait for the latest CPI data delayed by the U.S. government shutdown. Well, trade tensions ease between Washington and Beijing on a plan for Donald Trump to meet Xi Jinping next week in South Korea. But the White House relationship with Canada takes another turn as President Trump says he will terminate all trade negotiations with Canada. Well, we have a range of top guests from Berlin and from the Berlin Global Dialogue this hour, including Wei Li, Global Chief Investment Strategist at Blackrock. We'll be speaking to Bernie Mensah, President of International at Bank of America, and Oleksandr Bornyakov, Ukraine's Deputy Minister for Digital Transformation. Now, first thing is first, so there's quite a lot going on in the markets. I'm looking at European stocks. Actually, they're edging higher. U.S. equity futures also gaining a little bit. There does seem to be a mood music out there that trade tensions are easing ahead of a key inflation reading. Again, positive earnings also continue to support the equity market. It's not the case across the board, but you do see real pockets of strengths. We heard from the French drug maker Sanofi. We heard from NatWest. We heard from Holcim and Saab, for example, among the companies that gained after earnings beat expectations. We're also getting some data, PMIs from the Eurozone. This will have a huge impact on the thinking of traders across the world, especially when it comes to ECB decisions. Eurozone October composite PMI rising to 52.2. Anything above 50, as you know, is expansion. It's also a little bit above forecast of 51.1. So we have another packed show this Friday. Geopolitical tensions are boiling over once again, with President Trump saying he's terminated trade talks with Canada. At the same time, Trump's plan to meet with the Chinese president next week in South Korea is boosting sentiment. Tech stocks driving much of the gains tied to the AI boom. Banks preparing to launch a record $38 billion debt offering to help fund data centers tied to the software giant Oracle. So let's get straight to our market expert, Wei Li, Global Chief Investment Strategist at Blackrock, who joins us now. Wei, I love speaking to you, especially on these days where there's so much coming from all sides. You have a clarity of thought that makes everything put into place. How much focus will be on the inflation report? Now, this is a bit of an oddity. We haven't had any inflation report from the U.S. for 3 weeks. We're getting it today. It's for the September, and then we go back to darkness.
That's right. That's right. I think today inflation is the biggest market driver, but beyond today, I think earnings, trade headlines are going to drive market volatility. I think when it comes to inflation, the big picture is that core goods have been increasing and really breaking out from a 25-year deflationary kind of period, and core services in the context of still persistent wage is not likely going to stay low. So I think for now, yes, the Fed has the macro cover by ways of a weak labor market to keep cutting rates. Next week's 25 bips of cut is basically a foregone conclusion, but beyond the medium term, actually inflation is going to still be a challenge.
Wait, when you look at the inflation report today, could it actually change expectations for the next week, or does it change the mood music longer term?
I think it's more longer term. I think next week, the only uncertainty in terms of the Fed communication is around QT rather than the rate decision. But markets are pricing quite a lot of cuts by the end of next year. And I think that's where maybe there is room for disagreement. Maybe markets are pricing in too many cuts in the context of there is still room for tariffs to feed through to goods inflation. And I think we'll have to kind of deal with that as we head into next year.
Wait, I mean, trade is another huge thing. And actually, 2 weeks ago, I would have probably asked you, are the markets now looking beyond trade tensions? And actually, we're back in the full, in the full because of U.S.-China. Like, how do you unpack all of this?
Well, it's complex. I would observe that the Bloomberg Trade Uncertainty Index is starting to rebound again, having fallen a lot from April high. And I think that's just the nature of negotiations, right? Back and forth. And I think the the bigger observation I would make is that it's not going to be very likely to generate alpha by just following the day-to-day blow-by-blow trade headlines. On one day, we're going to make a deal. On the next day, we're not going to meet, and now we're meeting again. So it's really hard to generate alpha in that way. I think having a clear frame is important. And as you know, Francine, we call it the immutable law in Blackrock, the things that cannot change too quickly. And if markets price in extreme changes within a short period of time, we would lean against it. And this is why we are still pro-risk, even though trade uncertainty is higher, because there are things that just cannot change too quickly. The two biggest economies decoupling within a short period of time, unlikely. A trade deficit to close despite a significant reliance on foreign funding from a U.S. government perspective, unlikely. So when that gets priced in, we fade.
Wait, do you have to have a call on absolutely everything? So we had big news overnight with Canada. And again, and there are certain parts of the market that say maybe this is a Trump administration being concerned about what SCOTUS, the Supreme Court, will do when it comes to that big tariff decision in November. Again, are we overanalyzing, or do we really need to try and understand, what these little bits mean in terms of policy from the White House?
I think there is a difference between kind of the day-to-day blow-by-blow trade headlines and the longer-term landing spot, right? So you can either kind of, from a very tactical perspective, fade extreme moves, which is what some of the investors do, or you can position for what you think is a reasonable longer-term landing spot, somewhere between kind of 17%, 20% average tariff rate may well be a reasonable kind of target to position portfolios. So depending on your kind of trading/investment strategy, you can do very short-term or longer term.
You spent quite a lot of time also looking at earnings. And this, you basically say you have to be very selective. But overall, we were expecting this earnings season to be tough, and it hasn't. Does it come from lower expectations, or are companies just finding a way around all these uncertainties?
What is really interesting is that actually expectation for U.S. earnings has been increasing. So for the whole calendar year of 2025, the expectation was going to be 9%, and now it's 11%. So it's actually increasing. But U.S. earnings strength is starting to broaden out, right? It's not just the tech sector that is expected to deliver 14% year-on-year in Q3 earnings. The rest of the market outside of the Magnificent Seven is expected to deliver shy of 8% in this upcoming quarter. So you see a bit of a broadening out momentum, perhaps helped by cutting cycle and just generally resilience in U.S. economy. And that is why we favor U.S. equities over likes of European equities, where actually for the whole calendar year of 2025, expectation is for them to not grow earning much at all. So being selective in European equities like industrials, financials is important.
Are you surprised that AI keeps on exceeding expectations? We keep on saying it's priced to perfection, but then the earnings report comes in and they're pretty good.
Yeah, they are. I think AI is entering a very interesting phase right now where the build-out becomes more capital intensive. Because up until now, it's basically these hyperscalers funding their capex from their huge piles of cash, free cash flow. And that has been no problem. But now the new entrants in AI build-out are having to tap into private credit, tap into credit market using joint ventures. And this is why there are increasing questions around return on invested capital as the expansion becomes more capital intensive. But I think the jury is still out there in terms of if these trillions of capex estimated in the coming years are going to be justified. But in the meanwhile, it's just very costly to stay out of this trade, right? If you think about, we're still early in the adoption phase. So you get this sense of race against time. Will profit outrun depreciation? And this is the tension that we have right now. But we still like this theme. We're still early in the adoption phase. And I think a big question remains, who are going to be the ultimate winners versus losers? Is it going to be the builders of AI, or if we're talking about potentially excessive build-out, turning GPU and compute into commodity, maybe the application layer?
Wait, do you see, like, as an investor, we talked a lot about credit also last week and what that meant, but is it going to be less linear in terms of news flow and much more volatile? Like we've seen, do we need to get used to what we've saw in the last 8 months?
Maybe. I would say that the credit cycle has been missing, right? You look at kind of the default level, you look at the spread, you don't really see a very meaningful, pronounced credit cycle, perhaps supported by easy liquidity, perhaps supported by fiscal stimulus. But we are at a moment where differentiation and dispersion is going to be very, very key. Private credit are likely going to play a bigger role because of the blurring of the lines between public and private in the context of building and financing the transformation. So certainly we think this is a big theme, but differentiation, dispersion is going to be increasingly important. I'm paying a lot of attention to kind of the different categories of credit and also the potential increasing in payment in kind and so on and so forth. But right now we like fundamentals. Leverage is not exceedingly high, and there's a reason that spreads are low.
Wei, thank you so much, as always, for joining us. Wei Li, their global chief investment strategist at Blackrock. Now, U.S. trade negotiations with one of its neighbors has been thrust into chaos. We were just talking about Canada. President Trump announced he's immediately severing talks with Canada. While posting the announcement on Truth Social, Trump called Canada's behavior egregious. He's taken issue with the tariff and featuring the voice of former President Ronald Reagan. Well, let's bring in Brendan Murray, who leads our trade coverage. So, Brendan, what was in the ad, and exactly how is Trump's decision likely to impact the Canadian economy?
Yeah, exactly. So I think you have to chalk this one up as more of a tantrum than anything that really disrupts the trading relationship between the U.S. and Canada. And you have to see what President Trump didn't do as well, or didn't say, is that he would raise tariffs on Canada because of this advertisement. So he's just threatening to suspend talks. There weren't really any signs that they were locked in any serious negotiations yet. They are looking ahead to the middle of 2026 when the USMCA agreement has to be renegotiated and reviewed. And the Trump administration wants to take those talks one-on-one with Canada and one-on-one with Mexico. So this is just President Trump kind of setting the tone for what will be months and months of negotiations. But the more interesting part of that social media post was the reference to the Supreme Court decision. You could read into that they are getting nervous in the administration, that the court is not going to rule in their favor. Prediction markets see a 60% chance that the Supreme Court is going to rule against President Trump. So he's trying to sort of sway public opinion, that he's saying that Canadians are trying to sway public opinion against him, and that's why he lashed out at Canada.
So interesting. Brendan, at the same time, the presidents of China and the U.S. are set to meet next Thursday. Now, this was a meeting that was like off and on and off and on. What can we expect from those talks? But also, why is it so difficult to know whether they're happening or not?
Yeah, so we're heading into this fifth round of trade talks between the U.S. and China, between Secretary Bessent and his Chinese counterpart. And we've seen a pattern all along. They escalate with the rhetoric, and then they de-escalate when they get together. The base case here is that they will extend the truce that they have and not imposing more export controls or higher tariffs on each other. They'll kick it out another 90 days. Maybe they'll even extend it longer. Secretary Bessent has said it'd be nice to have a longer than a 90-day roll, as he calls it. So the rhetoric sounds like the relationship is pretty tense. But at the end of the day, we've seen this movie before, and they end up at a deal. But that said, they are threatening some pretty drastic things with export controls on each other. So it's going to take quite a bit to get them, once they get to the negotiating table, to reach a deal so that those escalations don't happen.
Brendan, thank you so much. It does definitely feel like a high-stakes meeting. Brendan Murray there in London. Now, Bloomberg also understands that the French president, Emmanuel Macron, has told EU leaders to consider using the bloc's most powerful trade tool against China. That's if they are not able to find a resolution to Beijing's planned export controls on critical raw materials. So let's bring in Susan Lynch, our Brussels bureau chief, who's with me here at the Berlin Global Dialogue. Thank you, Suzanne, for joining us. Look, I mean, first of all, like, Europe is in a little bit of a precarious situation because they're kind of caught in the middle, and now Macron wants them to retaliate against China.
Yeah, we reported this last night. EU leaders obviously were meeting in Brussels yesterday, and during that closed-door session, the French President Emmanuel Macron said that this anti-coercion instrument, which is a trade tool that the EU has at its disposal, should could possibly be used against China. Now, I mean, I think the message here from Macron is that Europe needs to toughen up when it comes to China policy. I think there was widespread agreement, and Chancellor Merz, the German Chancellor, said afterwards, look, we're not at that point yet, but I think it speaks to the gravity of this situation now for Europe. Some of Europe's top leaders last night at the summit wanted to discuss China. They talked about these restrictive export controls that are impacting Europe. Europe, like a lot of places in the world, but particularly Europe, is very dependent on Chinese rare earths. Everything from electric vehicles to the defence industry. So a lot of concerns about how this planned move by Beijing is going to affect European industry.
I mean, a lot of the talk this week is also on those Russian frozen assets. Like, where are we?
Yeah, that was a big debate yesterday. It was funny. We started off the EU summit yesterday with a decision on sanctions. By the end of the evening, there were all kinds of divisions around other issues, and this included this plan to use Russian immobilized assets to help Ukraine. The issue here is Belgium. Most of these assets are located in Belgium at Euroclear, the clearinghouse. So as a result, Belgium is more on the hook than anyone else from this if these assets are used. So the Belgian Prime Minister, Bart de Wever, really went in strong ahead of this meeting. He said he had red lines and he wasn't prepared to move on this unless his concerns were addressed. He repeated that within the meeting. So the result was that the EU did not really move forward on this. What they said was, yes, they want to continue helping Ukraine. The European Commission will come forward with a proposal on how this plan with the assets will work. But this has now been delayed, a political decision, until December. That's potentially a big problem for Ukraine because it needs the money. It's got financing needs right into early 2026. So this delay is not good news for Ukraine, even though the sense we get in Brussels is that this plan will happen eventually. It's just that leaders were not expecting this kind of response, this resistance to such an extent from Belgium last night at that summit.
Suzanne, thank you so much for the terrific briefing. Suzanne Lynch there, our Brussels bureau chief, and we'll be here throughout the day, of course, also bring you updates from the Berlin Global Dialogue. Coming up, we'll discuss how Ukraine is seeking to put technology at the center of efforts to defend and rebuild the country. We'll be talking to Oleksandr Bornyakov, Ukraine's Deputy Minister for Digital Transformation. That's next, and this is Bloomberg.
We had a good discussion on the reparations loan to be financed with immobilized Russian assets, and it allowed us to identify points we still need to clarify, and then indeed we will come back with the different options that we will develop. Let me underline again, we will always respect European and international law while we are taking this work forward that we've just described.
Well, that was Ursula von der Leyen, the European Commission president, of course, discussing the plan to tap frozen Russian central bank assets to aid Ukraine. That's one of our top stories. Now, the EU Defence Commissioner has also weighed in, saying the bloc should use funds from its €150 billion investment plan for its defence industry to help Ukraine.
Very important decision can be on so-called reparation loan. Using those frozen assets without confiscation, but using frozen assets to send to Ukraine 150 billion euros, which can be used for defense. And maybe that could be a signal to Putin where he will start to understand that he really will not achieve anything in Ukraine.
Well, we're now joined in Berlin by Oleksandr Bornyakov, Ukraine's Deputy Minister for Digital Transformation. Deputy Minister, thank you so much for joining us. Look,
hi everybody. My pleasure.
It's so good to speak to you. I mean, you basically have a government services app called DIA, where people can do things like exactly, they can do, pay taxes. It's basically the infrastructure that allows people to interact with a lot of the digital government. How difficult is it to implement it right now in Ukraine?
Well, we started implementation back in 2020, and I think it was even more difficult back then because of all this opposition and the pressure that, you're going to ruin everything. Like, there was a huge opposition from many other counterparties, other ministries, that we're going to destroy everything. But it didn't happen. And DIA mostly is about digital papers. So we started from driver license, passport, then it went to car titles, birth certificate, tax ID number. So I it's a storage for all my official papers, diplomas, everything. So 22 million people as of today using DIA. So it's basically almost everybody in Ukraine, because you cannot use it if you're not 18 years old. But, so that makes it popular among all population of Ukraine.
Deputy Minister, I guess the difficulty now is that there are power cuts, right? There are power cuts. You need to defend like the data infrastructure. So what kind of efforts go into that? Even cybersecurity.
Well, you cannot hack something that is out of the grid. So, well, it's a very painful topic, first of all, because I just came from Kiev. At my home, there was no electricity for 10 hours straight. My parents' house, 2 days no electricity. So they in Chernihiv. So that's Sumy, Chernihiv. That's cities that close to the border. They suffer most. There are contingency plans, and there's a lot of help, and people do whatever they can. But unfortunately, there is no way to help if every day they continue to bomb. So and they change the tactics. So before they're trying to send maybe hundreds of Shaheds to different targets, maybe they were hoping to reach maybe another 100 targets. But now they choose 2-3 targets and then send 20 to 30 missiles.
And these are energy projects.
Yes,
right?
yes,
mainly energy projects.
Yeah. So and we face another challenge. So despite of the efforts to protect them on cybersecurity level, on physical level, you cannot protect. I don't think it's a way to protect if there is a 20 drones with their 100 kilos of explosive hitting the. If you shut down 10, another 10 will do the job. And then they also send 3 or 4 ballistic rockets to the same place.
Deputy Minister, in terms of the cyber attacks on some of these energy projects, assets which are again crucial to running the country, have you seen a step up?
Well, this is not the big news. It's not on the news often, because when the pictures of drones hitting targets are selling better, but cybersecurity threats, and it's not just. They not went away. So they constantly attacking every day. We have their cybersecurity centers that monitor 24/7 every day, and they record dozens of incidents every day on different.
Is it getting worse?
I wouldn't say so. I think they're pretty much stable, and in cybersecurity world, it works in a little bit different way rather than when you send drones. Sometimes, to successfully penetrate a target in cybersecurity world, you have to wait a month. So, so the curve is not hitting silence, hitting silence. So it's usually silence, then hop, big incident, because they found a way to penetrate. So that's why sometimes it's no news on this front, and then some of the big news. Because it's really take time. They trying to look away.
Can you talk to me about the Ukraine Phoenix Tech Fund? So this is a pet project to basically try and get partners and money in to support the ecosystem for tech in Ukraine. How's it going, and who are your main partners?
We were in touch with the founders Dominic and Peter, who was big friend and still big friend of Ukraine, and his other partners like Chuck. From New York University, and we've been helping them with the a recognition and underlining the importance of this fund, because part of what we do is in defense tech we're trying to allocate enough resources to develop those solutions that kind of keep Russians at bay. So Phoenix Fund is very important, and it's especially important because today. As a deputy minister, I'm in charge of policy making and startup ecosystem venture. So that's my actually job, to support this industry. This is what I have to do straight away. And the fuel in this industry are money. And when the border was closed, so our civil aviation is not working. It's really hard to get, and it's really hard to get out of Ukraine. So this venture and startup ecosystem, it's global. So of course it faced existential threat. And funds like Phoenix, they bring money into Ukraine, so that's essential for us.
Okay, such an interesting conversation. Thank you, Deputy Minister, for joining us. Oleksandr Bornyakov, there, Ukraine's Deputy Minister for Digital Transformation. Now, coming up, private credit giant KKR tells us the sector poses no systemic risk to broader financial markets. So we discuss if the credit jitters are over, stated with the Bank of America's international president. He's Bernie Mensah. He's coming up next, and this is Bloomberg. Welcome back, everyone, to a special edition of The Pulse, live from the Berlin Global Dialogue, uniting leaders from business, politics, and academia on the biggest issues facing the global economy. But first, here are the top stories making headlines this morning. Private sector activity unexpectedly jumps in Germany to a highest level since May 2023, but a less positive picture in France, with the sector contracting over the budget and fiscal uncertainty. Trade tensions ease between Washington and Beijing on a plan for Donald Trump to meet Xi Jinping next week in South Korea. But the White House the White House relationship with Canada takes another turn as President Trump says he will terminate all trade negotiations with Canada. Now, we are full of data. Also, I know there's a lot of excitement because of the inflation report out of the U.S. It's like a glimpse. We haven't had any data out of the U.S. for 3 weeks. We get the one today because legally we had to, and then we go back to the government shutdown with no data. The UK PMI, it's open for business, so we do have data there. UK October composite PMI coming in slightly better than expected, 51.1. Again, anything above 50 means expansion. The forecast was 50.5. Now, Henry Kravis, the co-founder of KKR, has pushed back against warnings that the collapse of Tricolor and First Brands is a sign of wider trouble in private credit. Well, speaking here at the Berlin Global Dialogue, Kravis said there was no systemic risk. Last week was quite a week. We had Jamie Dimon talking about cockroaches in certain private credit companies.
They don't invest.
They don't invest. But do you worry about something systemically wrong with private credit?
So let me tell you about private credit.
No.
Just recently, okay, we have a big private credit business at KKR. So do many other firms have private credit. Even banks have a sleeve of private credit. Everybody's talking about, oh my God, private credit's going to go bad. I do worry about one thing. I worry about those firms that don't have a driver's license, that have decided they want to get into private credit, have no way to drive, haven't passed a test or anything. And yeah, will they have problems? They could. I don't find it systemic. We don't take deposits. This is just really what it is. It's private credit. 2 big bankruptcies last 10 days. Not one penny of private credit was in them. But the market hit all of us that are in private credit because they assumed that was it. And then finally, once they figured out, well, this is really all banks, it was UBS and Jefferies were the 2 big banks that were the big lenders in that. I am not worried about a systemic risk issue in private credit.
The other question is it the banks or the private credit firms that suffer the most when we reach peak correction?
Depends. The thing you have to focus on if you're going to be in the credit business, what are my risks?
Right.
How am I protecting my investors, or how am I protecting my portfolio? And if you don't think about that, and you're only trying to knock the ball out of the park on every investment you make, you're going to have trouble.
Well, that was Henry Kravis, the co-founder of KKR, speaking here at the Berlin Global Dialogue. Now let's continue the conversation on markets and private credit jitters. We're joined by Bernie Mensah, International President of Bank of America. Bernie, thank you so much, as always, for giving us a little bit of your busy schedule. Yeah. The event is great because it kind of brings, all sorts of people together trying to figure out what happens next in the economy and what happens next in markets. What do you worry about the most when it comes to markets in the future?
I think at the moment there's a lot of talk of, are we peaking, are we end of cycle? So you need to be sort of cautious and careful about what's out there, and you're looking at the data all of the time. So there's no one thing that keeps me up, but I think that we should just be cautious, just given where market levels are.
Should we worry more about credit than we currently are? So, last Friday felt like it could be something that could snowball into something much bigger, even maybe something systemic, and now the markets have moved on to other things.
I share the narrative that is not systemic. There are one or two specific situations that have happened. There's some talk of perhaps fraud or not. I think if you look at the high yield index around about 300, 225, 290, we're not at the all-time tights. We're sort of near there, but then we're going through an easing cycle. So we should be complacent about idiosyncratic events that happen at the company level on the credit side, but it doesn't feel as if it's systemic, certainly not.
Does anything feel toppy? I know we talk about the AI bubble. We just follow the trade tensions. Every hour I feel like there's a new trade meeting that's on or off between the US and China, and now things with the US and of course Canada. Like, how do you see it playing out in how your clients see it?
Well, the first part of what you said, some things do feel toppy. You look at gold and you look at the S&P, etc. So it feels that way, but there's many reasons to think that some of those things should be where they are. There's been many, for those of us who've been around a while, you can get to these periods of time and have another leg of growth, and some of the fundamentals around that are relatively positive. In terms of the trade talks, I think we had peak uncertainty back in April, and then we've had certain flare-ups. I think China is probably the most relevant. Canada, US, and Mexico we'll see. But I think the market reacts the most at the moment when the Canadian tensions flare up, the Chinese tensions flare up, sorry.
Bernie, are you surprised at the way that some of your clients have been behaving because they've been cooler than expected and kind of trying to figure out the trade tensions and move away around them? Or actually, are they much more cautious than you expected them to be?
I think I've really been impressed in the sense that people are really trying to think things through. So I wouldn't say cautious, but I see a lot of work. This event's a classic example. A lot of work trying to look through. And I always say to them, try and look through the noise and the fog and try and figure out what's happening in the real, sort of either in the real economy or the real underlying trends. What's happening with CapEx? What's happening with AI? What is the slight recent dollar weakness doing to trade flows? What are the underlying inflation cycles? What are the real tariff numbers as opposed to the headline numbers that we've seen? So a lot of people are trying to work through that to figure out where the plane might land in a quarter or two.
Are they a little bit more used to the kind of volatility or news flow that we're seeing? So are you expecting activity to pick up?
Yes, I think that we've all gotten used to a different cadence of news flow since the start of the year. Activity picking up is interesting. There was a pickup in activity going into April. And so you've seen some of that lag effect come through. I think as we come through end of Q4, I do see some activity picking up in terms of investors sort of figuring out, okay, what do we do through to the end of the year and how do we position through to next year? And I think for corporates who sort of said, well, we'll wait for some of the uncertainty to dip, there's a broad sense of what the broad level of tariffs are, 10, 15%. And so if you assume no big flare-ups, you can start to plan through that.
Are you optimistic about Europe? I know at the Berlin Global Dialogue, of which you're an integral part, we've been talking so much about Europe, not giving up, kind of trying to stay relevant and competitive.
Yeah. It's the wrong analogy. I say 2 steps forward and 1 step back because that's a sort of a movement analogy. But I'm optimistic about 2 things and worried about 1. I'm always optimistic in Europe. It's an area with incredibly high savings rate, incredibly educated and talented workforce, and incredible infrastructure installed base that is difficult to replicate elsewhere. So those base elements, it's an incredibly wealthy region. So that's a good thing. The other thing I'm actually impressed with is, or noticing, is the countries seem to be moving ahead. I noticed a letter by a bunch of EU leaders on the 17th, on the Tuesday, I think, this week, urging action. There's the Draghi report out there. I read a report where he said, stop asking me what to do, just do it. So those are 2 positive things. And this piece where I'm a little bit cautious about is it does feel as if the countries are a little bit ahead of the EU in terms of Brussels. And you have this sense, being here, that the countries are saying, hey, Brussels, Commission, can you come with us? Because we need to move along. And I think that if they moved in step in terms of some of the deregulation, the simplification, some things like the CSRD rules, Corporate Sustainability Reporting Directive rules and others, then you could really see some momentum pick up. But countries like Germany, by taking a bit of a country view in terms of the release of the debt brake, etc., seems to be moving the dialogue along.
Do you think Brussels is listening? We also heard the Chancellor Merz here talk about a pan-European stock exchange. I mean, we still don't have a capital unions market, but are you hopeful that actually something will happen in our lifetime?
In our lifetime is a good way to... I think that, I hope they're listening, I really, really do. You would hope that given the governments that are in place is a little bit where the electors are, Brussels must be listening. And I assume that they're very well intentioned in thinking through other things they're trying to achieve. So I'm not sitting here saying that there's, not good reasons for perhaps the caution that they're putting into play. So I hope that with the feedback from the private sector, feedback from places like this, from the individual governments, from the leaders, that they are listening and taking action.
Are you expecting more IPOs or deals? We're seeing green shoots, I guess, in Europe, but are you expecting that to really increase in the next 6 to 7 months? And what does it mean for Bank of America? How can you capitalize on it?
Yeah, well, we've had a great quarter. We just announced our results last week, and our pipeline looks terrific, and the level of dialogue that we have with our clients is really at very high levels. You might say some of that is a lag because the markets were shut for a period of time. So I think that's a good thing. But apart from what is good for us, I think it'll be good for our clients. It gives them another avenue. The private markets are big, they're important, there's a lot of activity happening there. Companies that are coming to IPO are much older than before. They're staying private a lot longer. The number of public companies has dropped a lot since 2004, 2005. So I do think there's space in the public markets for people to access, for pricing to take place, for alternatives to be there. And the markets are ready for that. So certainly from our book of activity, I should see more activity going forward.
I mean, in terms of deal making, how's Asia looking compared to Europe, compared to other parts in which you're in charge of?
I think one of the great things from where I sit is that this, actually, for all of the talk of deglobalization, there's an incredible amount of just cross-border activity. We've done deals out of Scandinavia into the US, Scandinavia into Europe. We've done deals out of Japan into Switzerland in recent times. And one of the things that we're seeing, actually, just given the new environment, is that actually companies are having to think global. Where should our supply chains be? Where should we have resiliency? Where should we actually have more exposure than maybe we didn't before? And whilst everybody's still focused on the US, and it's a tremendous opportunity, you just have a sense that people are saying, well, look, I want that plus. Maybe I should have a little bit more in Europe. Maybe I should have a little bit more in Southeast Asia. So that's driving some good dialogue.
Where are you seeing capital? I guess, Bernie, one of the questions is that even with these renewed trade routes, a lot of companies that look to list then just want to go to the US because it's a bigger capital pool.
Yeah.
Does that change with time?
It should change with time, over a period of time, because one is where we are in Europe. If Europe gets its capital markets union in place, then Europe should be well, then that would. At the moment, a lot of European savings are going into the US actually, and helping in that market. There are other financial centers that are looking to grow, to provide some pools of capital. I think all of that makes the pie bigger, frankly. I can see a world where there's more activity in the US, but more activity in Singapore or Hong Kong, and more activity in London or Europe, because as more pools of capital are drawn in, there's more to go around.
Bernie, thanks so much for your time today. That was Bernard Mensah, International President of Bank of America. Now, coming up, we'll have plenty more from the Berlin Global Dialogue. Also, our Oliver Crook hosting a panel here at BGD called Financing in a Multipolar World, Strategies for Economic Security. Speakers include Saudi Arabia's Minister of Economy and Planning, Faisal bin Ali Ibrahim. That discussion continues on Live Go on your Bloomberg terminal. Now, this year has been dismal for London's IPO market, with fundraising at 30-year lows and notable companies listing elsewhere. Bloomberg Originals has been looking at why the city's exchange has been losing its appeal.
Things look like they're going from bad to worse for London's IPO market. In 2006, more than $50 billion was raised during initial public offerings. But in 2024?
You can see that it is relatively healthy, and then it just drops off.
Particularly since 2008, we've seen a fall in about 40% of the number of companies listed in the UK.
The first half of 2025 has been the worst for IPOs since 1998, and that sounds terrible.
London falls out of top 20 IPO markets as fundraising slumps 69%.
In the global rankings, the UK is now all the way down here. And this is just one of a string of factors undermining London's more than 300-year-old exchange. A few green shoots have begun to sprout under London's trading floor, but buried beneath a financial malaise decades in the making. This is a story important to ordinary people as well as investors. But just a heads up, it's not a happy one.
It's a shocker, isn't it? It really is.
And subscribers can watch that documentary right now on the Bloomberg terminal, Bloomberg.com, and of course, Bloomberg Originals YouTube channel as well. Coming up, the U.S. hurtles towards the longest government shutdown in history as both Republicans and Democrats refuse to back down. Well, Pimco's head of public policy, Libby Cantrill, joins us next, and this is Bloomberg. Welcome back, everyone. The U.S. could soon witness the longest government shutdown ever recorded after blowing past the 3-week mark. Now, both Republicans and Democrats show no signs of ending the stalemate, as some of President Trump's unusual budget maneuvers lessen pressure on him to broker a solution. Well, we're now joined by Libby Cantrill, head of public policy at Pimco. Libby, as always, thank you so much for joining us. I mean, there's a lot of excitement because actually we have inflation data today, but that was a legal requirement. And then we go back to the shutdown and no data. How does the shutdown end?
Yeah, well, nice to be with you. I mean, I think that is the main question for us and for our clients as well. Our concern was that if the government were to shut down, there would be no natural catalyst to reopen the government. If you recall, the longest full shutdown was back in 2013. That was for 16 days. And the catalyst to reopen the government then was in order to raise the debt ceiling. They funded the government and raised the debt ceiling. You fast forward to 2025, and there is no real catalyst. And in fact, it is a little bit eerie. In Washington, folks are incredibly comfortable with their political positions. President Trump, the Republicans, very comfortable denying a vote and denying negotiations on the Obamacare subsidies. Democrats, who are usually agitating to reopen the government, they're very comfortable keeping the government shuttered, again, in order to shine a spotlight on the issue of healthcare. So it is a little bit surreal, honestly, the fact that there are real implications for the real economy, for data, as you mentioned. But again, folks are really comfortable. So our expectation, what we're telling clients, is that we could see potentially the government reopening in November. Maybe we could be in Thanksgiving. The government could still be shuttered. There is, it's an outlier, but there's also a tail risk that we may get to Christmas and the government's still shuttered. So this will, what our concern is this will have likely deeper economic impacts the longer this shutdown lasts. But again, no real political catalyst to reopen the government at this point.
Libby, I mean, and this is something that we were discussing, this morning, is that there doesn't feel to be any urgency because of the news flow, because there's so much actually that the Trump administration is also working on. But how much of this is they think they're winning the messaging around this, that this is about votes longer term or making the other party look bad?
Yeah, I think that is right. Again, I think that both sides think that they are winning with their respective bases. And if you look at polling, that's probably in some ways true. Each side sort of blames the other, which is, kind of the business as usual these days in Washington. However, usually shutdowns are a political loser for both parties, just by and large. And I think this is no exception. As the longer this goes and the more the government services are impaired, the more flights are delayed, the less able folks are to get a mortgage loan through FHA and what have you. I think the more folks are going to be mad at both sides. And you're already starting to see this a little bit in the polling. So that could be a catalyst. It could, but again, right now, both sides think that they're winning the messaging war. They think that they're winning kind of the political issue of the day. As you said, there really is no urgency. The House is not even in session. I mean, the House hasn't been in session for now going on 5 weeks, and they look like they will be out of session again next week. So again, we're expecting November to be the earliest that the government reopens. We could be until Christmas, however.
Libby, we also, President Trump, from what we understand, likes to negotiate. So could he just turn around and find a deal on health care?
Yeah, he is the wild card, and I think that is something it's a good thing to flag. I mean, he is this is an issue, and just as a background, this is the issue kind of the day. The issue of the focus here is around these enhanced Obamacare subsidies. They were passed during COVID, and then they were extended in 2022, and they expire at the end of this year. And so Democrats think this is a good political issue. If you look at just again polling, voters usually rank healthcare as sort of the top 3 issue. In terms of the things that they vote on. So they do care about this. And I think that, President Trump, he knows sort of the zeitgeist of voters as well. So he is sort of the wild card here. You could see him pivot. I will just say, though, that, again, the longer this occurs, and the markets have sort of shrugged this off, but, I think our concern is that you start having some nonlinear economic impacts. Our view is that if this stays shuttered until November, you could see a point being shaved off of GDP. Now, some of that will be reinstated when the government reopens and federal workers get repaid. But the longer this goes, the more potential you have for sort of deeper economic scarring. And of course, as you said, no data. And the longer this goes, not only are we not going to have data releases, despite today, we're going to have no data collection. So these are, I think, going to be increasingly problematic. Both for politicians, and again, Trump is the wild card here, but also for the real economy and then potentially for financial markets.
Libby, how difficult is it to try and understand, or what's your base case for what the talks between the U.S. and China could yield between the 2 presidents? And does that change the public discourse back in Washington?
Yeah, I mean, it's a great question. And here I'm in London. I was in Europe earlier this week, and of course, this is one of the top questions that we're receiving from clients is sort of what to make of this dynamic. And I think that the best that financial markets can hope for from this potential meeting between President Xi and President Trump is really a détente and not a deal. I think that the expectation for phase 2 trade deal or what have you, or something even more fulsome than that, something that even President Trump has outlined over the last few days, it's possible, but I don't think it's really probable at this point. In some ways, President Xi is taking a page out of President Trump's playbook from Trump 1.0. He is using some of these sort of economic coercion tactics that the U.S. has used against China, previously. And so, this is, I think, quite a different dynamic than, again, sort of the previous administration, or Trump 1.0, if you will. So again, I think that the expectation is, détente, the best case scenario, but not a deal. And I will just say, and something we're flagging for our clients, is that there is a tail risk here. And this, as we've seen, this relationship can deteriorate pretty quickly, not only in terms of a ratcheting up of tariffs, but I think more importantly, maybe to China and also to the U.S., these sort of export controls, whether it's on advanced technology or whether it's on rare earths. So this, I think that is the tail risk in the market, that this relationship, which is already fragile, sort of simmering, if you will, can boil over, really at any moment.
Libby, thank you so much. As ever, Libby Cantrill. And then, of course, we have to see what the Supreme Court also decides on the tariffs. Libby's head of public policy at Pimco with a terrific briefing on what we're seeing and what we could see. Now, it's been a busy couple of days here in Berlin. Let's bring in Chad Thomas, our Europe executive editor, who's been with me throughout the day. Look, it's been an exciting couple of days. What's your main takeaway, Chad?
Well, I'm going to be watching very closely a couple of things still coming today. One, of course, is your panel with the French and German central bank governors. I'm really curious to hear what they have to say about setting policy when we have so much change happening in the world. How do you deal with the uncertainty of things like Trump, as you were just discussing, calling off the trade talks with Canada? We'll also be watching, or I'll be watching very closely, what the Mercedes-Benz CEO has to say today. As you know, we've been watching Nexperia, this Dutch company that many of us have probably not thought about very much, to be honest, until very recently. They're a big chip maker. There's a big dispute between the Dutch government and China over Nexperia. And we're hearing, and from our sources, that car makers are in a dire situation when it comes to their chips, because Nexperia is one of the biggest providers of, they're not specialized chips, but they're chips that are in every car that we buy. And so we could be days away from shutdowns of car factories in Germany, elsewhere in Europe. So that will be something I'll be watching very closely today as well.
Yeah, and then you have Macron, a great Bloomberg scoop, basically saying, look, Europe should fight and retaliate against China.
Yeah, and that was really interesting, as you say, one of our scoops last night from the summit, that Macron was saying we need to use the toughest tools that we have in our kit to deal with the fact not only we're talking about Nexperia, but we're talking about rare earths as well, and the fact that China is putting controls on the exports of rare earths. Big issues for the EU when it comes to how they're going to deal with China, and of course also the continuing discussions with the US as well.
Chad, thank you so much. Chad Thomas there, our Europe executive editor, of course, masterminding all of our coverage from the Berlin Global Dialogue. Now, don't miss our panel conversation with the Bundesbank president, Mr. Nagel, and the Banque de France governor, Mr. Duguerreau. We'll have plenty more throughout the day. And of course, it's inflation data from the US. The government shutdown just taking a brief pause. This is Bloomberg.